Hello, everybody. Sean Iddings from Microcap Club here. We're doing a business breakdown of Kingsway Financial Services. We have JT Fitzgerald, Kent Hansen, and Mark Funderwell, one of our Microcap Club members here today. Kingsway Financial Services base business offering warranties for automobiles and HVAC system generates the cash for their fledgling search funds business. Under Kingsway's Search Accelerator program, new business school graduates using Kingsway capital leveraged with bank loans purchase very small private companies from retiring founders and become the chief executive officers. While Kingsway owns the businesses, the operators and residents are compensated based highly on the acquired business performance. To date, Kingsway has had 5 operators and residents acquire 6 companies. Currently, 4-member business school graduates are searching for an acquisition with a goal to add 2 or 3 companies each year. So, JT, can you tell us a bit about your background prior to becoming the CEO in 2018?
I came to Kingsway in 2016 and became the CEO in 2018. Prior to that, sort of post MBA and up until 2016, my professional career was entirely in and around the search fund ecosystem. I ran a search fund out of business school, and then became an investor in search funds as an LP, and have been in and around that ecosystem for about a little over 20 years.
Awesome. Kent, you have the presentation slides. Go ahead and share your screen. All right, I'll let you, JT, take it away from here. Tell us a little bit more about Kingsway.
Super. Thanks, Sean. Great introduction. Quickly just remind folks of our forward-looking statements. If anyone wants to dig a little deeper, please refer to our filings with the SEC for a full overview of our risk factors. Gave a little bit of background on me. I'm also joined by our CFO, Kent Hansen. Kent, maybe just a quick background. So let's talk about Kingsway. Let's do the business breakdown. I think that we think Kingsway is a compelling investment opportunity. We're a lean holding company that owns a diversified portfolio of attractive businesses with dual engines for growth in a tax-advantaged permanent capital vehicle. Each of our businesses have great organic growth potential, and we have a strategy to grow inorganically via serial acquisition by leveraging our experience in the search fund or ETA model via the Kingsway Search Accelerator platform. Our portfolio businesses currently generate 18.5 to 19.5 million of EBITDA. We have roughly $625 million of net operating loss carry forward, so we won't be a federal taxpayer for a long time. And we've spent considerable effort over the last several years simplifying our capital structure and delevering. And most importantly, our businesses are run by exceedingly talented entrepreneurs in a decentralized but supportive structure with highly aligned incentives. Our current stated goal is to acquire 2 to 3 businesses per year in the KSX platform. Each of those businesses would have a target EBITDA of 1.5 to 3 million. As I mentioned, we have an intrinsically diversified cash flow stream from 10 businesses organized in 2 distinct operating segments, extended warranty and the Kingsway Search Accelerator, or KSX. In the extended warranty segment, we have 4 operating businesses serving the automobile and mechanical warranty industries. And these businesses have compelling attributes, including diversified, contractual, prepaid revenue at high margin and low capital intensity. In fact, negative working capital dynamics or investable float, operating in large and growing end markets. We also own 6 businesses in our KSX segment. These businesses are primarily B2B services companies in the accounting and HR staffing, healthcare staffing, vertical market software, healthcare services, and IT managed services verticals. These businesses were all sourced and now managed by our OIRs, whose profiles are in the appendix. We'll be posting this presentation to our website, so if you want to dig in, you can go to the appendix and and get more information. These businesses all possess great attributes like recurring revenue, high margins, low capital intensity, and operate in large and growing end markets whose growth is supported by long-term secular growth trends. And additionally, we have 4 current OIRs that are actively seeking acquisition opportunities that meet our defined criteria. We've leveraged the KSX platform to complete 6 acquisitions in the roughly last 3 years. And one of our guiding principles is the power of decentralization and the entrepreneurial energy that unlocks. And as such, we remain a really small group at the holding company level. We view our responsibilities as primarily capital allocation, strategy development and accountability, accounting and tax, and risk management. And additionally, we support our entrepreneurs with a wonderful advisory board that provides counsel on acquisitions, operations, and leadership. Over the last several years, our businesses have delivered consistent growth and adjusted EBITDA, driven by a combination of organic and inorganic growth. Our 6-year compound annual EBITDA growth has been 19%. And based on our current run rate, which includes the earnings of our recent acquisitions as if we'd owned them for the last 12 months, our operating company EBITDA is now 18.5 to 19.5 million. After a challenging few quarters, our warranty businesses are showing improvement, and our recent acquisitions in KSX have all started to accelerate. And we've made significant strides to delever the company, with roughly 52 million of net debt, primarily at the operating company level. We're now comfortably within our 2 to 3 times leverage target that we have. So now for a deeper dive into the Search Xcelerator segment. I assume that many of the folks listening or watching are familiar with search funds, so I won't go too deep into the structure, but I'll mention that as an asset class, search funds, or ETA, has generated very compelling returns for investors. I've cited some statistics from a recent Stanford Graduate School of Business study. And I would say that with over 600 data points, it's safe to say that the model is proven. Our Search Xcelerator program provides a unique opportunity for public investors to access the search fund model. We partner with highly capable entrepreneurs, or operators and residents, to identify, acquire, and grow exceptional businesses. It's a model that's proven itself over decades, building high returns on invested capital and building enduring value. As Sean mentioned, we currently have 4 active OIRs. Their bios are also in the appendix. Each one of these OIRs receives a modest base salary while they're searching on our platform. They then transition into the CEO role of the acquired business, typically as the founder of that company is looking to retire. We, Kingsway, provide the equity capital to finance the acquisition. And each of these OIRs then has the opportunity to earn up to 25% in the common equity of the business that they've acquired. We believe the model is highly scalable as we generate more free cash flow to reinvest in the acquisition. As I mentioned, we have a predefined set of criteria. Our goal is to seek opportunities that deliver enduringly high returns on tangible capital employed. And so we start with industry first. And so we are looking for businesses in industries that are large and growing, typically greater than 2 times GDP. And that growth is supported by long-term secular trends. Ideally, those industries are also fragmented with lots of opportunity for shots on goal, and also lots of niches in that industry, opportunities for small businesses to maintain a competitive advantage. We're looking for low cyclicality and low capital intensity, or businesses that require little additional capital to grow. And often looking for companies and industries who have an element of criticality in the product or service that they deliver to their customers. And the the existence of good business models in that industry. And so a good business model to us means a high percentage of that revenue coming from truly recurring sources, strong margins, long history of consistent profitability, and low capital intensity. And all of that translates into high returns on tangible capital. Based on where we operate in the lower end of the lower middle market, we've been able to acquire these businesses that we believe to be very reasonable valuations, between 5 and 7 times EBITDA. We use a prudent amount of bank debt to help finance those acquisitions as a way to enhance our equity returns without introducing significant risk. Often some component of the purchase is in the form of an earnout with the seller. And as we mentioned earlier, we, Kingsway, provide all of the equity capital to finance those acquisitions. And then that talented OIR transitions in and leads that business going forward with highly aligned incentives. And our goal currently is to acquire 2 or 3 businesses each year using this model. This is an overview of the businesses that I mentioned that we've acquired over the last 3 years, 6 businesses, 5 OIRs. Radix and C-Suite are in the accounting and HR staffing business. Secure Nursing is an HR staffing business. SPI is a vertical market software company. DDI is a healthcare services business. And our most recent acquisition, Image Solutions, is an IT MSP, managed service provider, providing IT services to small and mid-sized businesses. Each one of them is run by a very talented person with a long runway for growth, and we're really excited about their organic growth prospects. As we mentioned, we provide operational support to each one of our OIRs when they transition into the CEO role. We have an internal operating system we call the Kingsway Business System. It was borrowed heavily from the Danaher Business System. It's a package of tools to help our CEOs become effective operators in their small companies. And we also support them with an amazing advisory board. The bios of these 3 gentlemen are here, and they provide guidance on investment underwriting, operations, and leadership. Tom Joyce is the recently retired former CEO of Danaher. So that's pretty amazing. We use a lot of BBS tools, and so to have Tom working alongside our young entrepreneur CEOs to deliver those tools in the companies that they run is amazing. Will Thorndike, amazing investor and historian of investments in equity markets. Will is also one of the original participants in the search fund ecosystem and has a lot of great insights on what good acquisitions look like. And then finally, Tyler Gordy. We'll talk about Tyler a little bit later in the presentation. Tyler was our first OIR, acquired a business called PWSC, ran it successfully and exited in late 2022, and has great insights on leadership at a small company. Just a quick overview of KSX. As you can see, breakdown of revenue by company on the left, and then on the right, you'll see a significant growth in EBITDA, both organically and inorganically, now at about 9.5 to 10 million of run rate pro forma for the acquisition of Image Solutions. I assume people are going to ask, why do we have confidence that the Search Accelerator will work? This is a case study that we have. It was sort of a proof of concept investment. We backed Tyler Gordy when we acquired a small warranty business. Tyler transitioned into the CEO role with searcher incentives, like I mentioned. And we supported Tyler in his transition and then in the growth of the company. And he was able to bring an amazing team around him and get that business growing and unlock some entrepreneurial energy in that company. We owned it for about 4.5 years. When we acquired it, we paid $10 million for the company. We financed that with $5 million of senior debt. And we contributed 5 million of equity capital in the form of a preferred. The business was able to delever very quickly and start paying dividends. And then ultimately we sold the company for a little over 50 million, which generated amazing returns for both Tyler and for Kingsway. 10x net return to us, which translates to high 60s IRR. So really an amazing outcome, which gave us and our board the confidence to really lean into this model to grow via serial acquisition. I don't know that we'll be able to repeat these types of returns all the time, but it is indicative of the type of outcomes you can have when you take a really talented person in a decentralized model, provide them aligned incentives to behave like an owner, and support them as they grow that business. It's just a really phenomenal proof of concept. I'll turn it over to Kent to quickly run through our extended warranty segment.
Great. Thanks, JT. So this slide is showing the 4 warranty companies that we own. So 3 in the auto segment and 1 in the mechanical segment. Trinity is focused on HVAC, backup generators, LED lighting, warranties, and also has a part of their business is also in mechanical servicing of equipment. So if something breaks down, we can roll a truck to anywhere in the lower 48 within 4 hours of getting that phone call. But by and large, our extended warranty segment is derived from warranty contracts, and a big piece of it is with the vehicle warranties that we provide mostly on used automobiles. We go through different channels. IWS goes through the credit union channel. They have exclusive relationships with credit unions that will only offer our product to one of their union members who might be getting a car loan. In all 3 of our businesses, we do not do direct to consumer. So the ads you see on TV sometimes, or the mailers you get, that's not us. That's a tough market to go through. And so we sort of stick to going through independent dealers, which are PWI and Penn, or through credit unions, which is IWS. And you can see that we've owned these companies for a number of years. The last acquisition that we had was PWI just a little bit over 4 years ago in December of 2020. Similar to KSX, here we're presenting a breakdown of the revenue and EBITDA by each of the companies. On the left is the breakdown of revenue for the 12 months ended September 30th, which is the last time we reported earnings. On the right is the trend in EBITDA. The numbers in 2002 and before do include PWSC. It was a warranty company and included in these results. So that's why that's part of the drop off from 2022 to 2023 is we took out PWSC. Was no longer included in our results going forward after we sold them. And we did, the last couple of years, we did experience a lot of claims inflation. Not the frequency of claims, but the cost of a claim has been going up mostly due to labor rates going up, and some parts inflation as well. As we said in our last call, we've seen that start to moderate over the last few months. Just going to our outlook between mechanical and auto, our auto segments. We again in the auto, we're sort of some new, but mostly in the used market. Contracts are anywhere from 6 months to 8 years. I think our sweet spot is probably between 2 and 4 years of the policies that we offer. We do have strong relationships with our dealer networks. And again, like I said, IWS is in the credit union space, and those are exclusive relationships. Something to note, when COVID hit, the credit unions basically they didn't close down, but they really suspended sort of any talks to bring out a new or change a warranty carrier. And so that basically reset our pipeline. And because credit unions have these exclusive relationships and they don't move very quickly, it's taken us a long time to rebuild that pipeline. And this year we kind of saw our pipeline come back to pre-COVID levels. So we feel pretty good about where IWS is sitting in their pipeline and the opportunities that they have in front of them. We also see is, interest rates play a big role in not only auto sales, but also in warranty, because usually a consumer is looking to see how much monthly payment they can afford. And as interest rate goes up, that car payment goes up. And so either you can't fit a warranty into that, or they pick maybe something that's less expensive. And so we're optimistic as the Fed, continues to lower rates. No one knows what's going to happen in 2025, but usually as rates come down, that's a good thing for us. And also we've seen used auto prices start to moderate as well. So those really got spiked during COVID. Again, it makes a car payment more expensive. And so as that price comes down, that makes our opportunity to get a sale better than if the price was higher. On the mechanical side, we're really excited about that space. There really aren't a lot of competitors out there providing warranty products on HVAC, backup generators, LED lighting. Very few players in the space. We see a lot of opportunity in the future there. And so we're really excited about what Peter and his team might have in front of them going forward in the mechanical breakdown space. And mechanical is both residential and commercial as well. And I'll turn it back over to JT to wrap things up.
Yeah, so this is just highlighting a handful of the transactions that we've undertaken over the last couple of years to really transform the company. It's been a lot of work, but we've been able to delever and then use internally generated cash flow and the cash from some of these sales to begin our serial acquisition program under Kingsway Search Accelerator. So we're a very different company today than we were even 2 or 3 years ago. And yeah, just to sort of highlight again, we think that we have an incredible flywheel here to grow EBITDA with our dual engines for growth. Each one of the businesses we own has great organic growth potential, and we expect to reinvest the excess cash flows that those businesses generate via acquisition, leveraging our Search Accelerator platform. And just coming all the way back to the front, again, we believe that we represent a compelling investment opportunity for public company investors to invest in a business that has a great growth engine and exposure to a very unique asset class in a tax-advantaged permanent capital vehicle. Well, that's our presentation. Sean, I'll turn it over to you.
Thank you very much, JT and Kent. You did a great job going through the business. I personally don't have too much. I haven't looked into KFS before, so this was very helpful for me to understand the company as well. One question, well, how about before I even ask a question, I just want to reiterate to audience members that if you do have a question, feel free to go down to the bottom where the chat icon, click that, input it there, and we can ask that after myself and Mark have asked questions. But my question first would be, what are some of the intrinsic qualities that you guys are looking for in your OIRs?
That's a great question. We think a lot about that. I think that we've triangulated in on a set of attributes that we think are indicative of success as a leader in a small company. We call them the 5 H's. And in sort of ascending order of priority, the first is horsepower. And to us, that's intellectual capacity, but also omni-curiosity. We want to back people that are lifelong learners. The next are hunger, so an insatiable desire to be successful and do whatever it takes, and hustle, right? That grit, the tenacity, the perseverance to do whatever it takes to be successful. More importantly than that, we think humility is incredibly important, right? The ability to admit what you don't know and seek and take advice. And most importantly, particularly in a decentralized structure, but I think generally, we really value honesty, obviously unimpeachable integrity, but also transparency.
And is there like a specific process that you guys have that goes through and kind of gives you an idea of how they've done, or you've been able to see them over a period of time to come up with that evaluation of their qualities?
Yeah, so that's just been through kind of trial and error over the last 20 years of, kind of going back and back testing, what good looks like. There is no perfect formula for what an entrepreneur is going to look like prospectively and what the return should be like. But we think that those attributes are incredibly important. And so we have a very robust screening and interview process that tries to tease out those things. And so we're very focused on that on the front end.
And with your operational advising that you provide to some of the companies, can you just delve a little bit more into that if there's any specific sounds like when you're mentioning some of the board of directors, they've helped kind of create a system that you guys use when you're taking over a company. Can you just talk about any of that?
Yeah, I mean, I think it is pretty far reaching. So I think that start with, 100-day plan on the transition. What does day one look like? And helping them through how they transition into that business, build trust and rapport with the team, learn the business before they start making any changes, and then around time management and how to be effective managers of their time. As an operator in a small business, you get caught in the whirlwind, and so being able to toggle between urgent and important but not urgent, and making sure that they're focused on key priorities while being stuck in the whirlwind is an important component. And then a whole package of tools around value creation, whether that's kind of growth and of course Salesforce or new product introduction, and then a set of planning tools we call policy deployment that helps them identify their key priorities, develop action plans, and then a cadence of accountability around executing those plans.
Gotcha. And one member who's watching in just had a question about the horsepower, hunger, humility, honesty, etc. that you mentioned. Is there a specific process for figuring each of those out during those interviews?
Yeah, we use a process called top grading. It's been around for a long time, but it's a very robust interview process. It starts with, kind of a resume screen and then a screening interview to assess sort of cultural alignment and fit and aspirations of that person. And then we do a competency-based interview. And then we have what we call the comprehensive chronological structured interview, and go through, for all the way back to high school to today, and really focus on the gaps and the changes at big inflection points in their career, and drill in on that. And then we're big believers in the power of references. And so we're very focused on when we do those reference checks. A lot of people do a reference check at the end as it's almost confirmatory. We try to pull that forward in the process when we're talking to lots of people, and really use that as an opportunity to talk to people that the candidate has worked with and for in the past, and really drill down on those attributes with those folks.
Great job. I think I'm good with questions. Mark, do you want to go through with your questions?
Yes, please. JT, I think probably a lot of Microcap Club members are really not that familiar with search funds. I know the first time I've been investing in microcaps since 1996, but just public microcaps. And there's no public way to invest in search funds. So the first time I ever heard of a search fund was when I was looking at your bio when you joined Kingsway, because I owned some shares in the stock way back then. So I Googled search funds. What is this? I had no idea. So I'm hoping you can talk about what will really interest Microcap Club members is those historical returns, right? So they've been around for a long time, right? Since the 1980s, or maybe even further back than that. And maybe you know more about them than anybody in the world. You were a search fund person yourself, and then you invested in search funds. And then at Kingsway, you've created this search accelerator program and continue to invest in search funds. And you had the slide up there, the Stanford study says the historical returns are 35.1%, I think is what the number was there. And they update that every couple years or something. I mean, that's remarkable, right? Those are leveraged returns at 35.1%, but half of the money borrowed by the bank typically or something, right? But still, I mean, 35% is pretty good. Can you talk about what your experience has been, or maybe give some more detail on what the dispersion of returns, what do those look like? These are a few big hitters that make a whole lot of money, and most of them don't do very well, or whatever you care to share about, historical returns on search funds, because that's what will get Microcap Club members excited, or it should.
Yeah, you bet. So yeah, we cited the Stanford study. These are median returns, not mean. So I think that's an effort to control for some of those outlier outcomes. They're pre-tax returns. And so 35% IRR and a 4.5 times MOIC across all of the search funds that Stanford has been able to track since inception. So if you had invested in every search fund ever formed that they're aware of, including the ones that failed to do an acquisition, the ones that failed to return 100% of their capital to their investors, and the ones that were able to exit and generate a return, that would be your aggregate pre-tax return. There have been some huge outliers for sure. But what's interesting is that over time, and so the return, 10 years ago, if you had excluded the returns from the top 5, there was, a delta between that. So it might have been 36. And if you exclude them, it was maybe high 20s return. What we've seen is that there has been consolidation around that return, including or excluding the top 3, top 5 outcomes. And the dispersion of returns is getting much narrower, but the returns aren't going down, which I think speaks to the tightening of underwriting criteria for the investors in search funds. So when we talk about high return, the targeted high return on tangible capital, there has been definitely a focus on those types of criteria that I outlined around revenue quality, around industry, around margins, and around capital intensity. And so in the early days, I think people were, I bought a manufacturing business. It's not a business that I would buy today. It was very hard to grow. It's very capital intensive, predominantly working capital, inventory and receivables. And so it just required a lot of reinvestment in the business in order to grow. That would be that I would not have invested in that company today. And so I think that collectively, the universe of investors in search funds have triangulated around a set of criteria, which has created a tighter dispersion of returns, and that yet the aggregate returns aren't going down.
Okay, so I want to come back and talk about the nature of the businesses you buy a little bit more in a second, but I was having dinner with another investor a month or so ago, and they said, what, you take some 23-year-old new business school graduate and you make them CEO, and you think this is a good idea? Now, your operators and residents are not 23, but a lot of times they are first-time CEOs, right? And you just talked about the history of returns is remarkable, but a couple things, I guess. One is, what's the motivation of these kids? They're not 23. What is their background like? What does their biography look like typically? And what's their motivation? And then second, you discussed in your presentation a lot about your advice that you give from your advisory board. Can you talk about how you're helping the kids be successful, right? They're not really kids, but.
Yeah, I would say that searchers generally are more like late 20s to mid 30s. I don't know any 23-year-old graduates of business school, but and our searchers are probably skew a little bit later in career than that. Um, and before we go into how we support them, just come back to, I'm a big believer in sort of people-based investing, with the idea that over time attributes trump experience. Graham Weaver at Alpine Investors has a really great little picture of this, and it's just a simple graph. And on the vertical axis, you have performance, and on the horizontal axis, you have time. And if you plot two curves, one a high attribute person versus and then another line of experience, they have different slopes. And so the high attribute person will underperform the experienced person for a couple of years. But those two lines, because of the differing slopes, those two lines cross at about 2 years in our experience, 18 months to 3 years. And then the high attribute person is going to way outperform the experienced person. And so I think search funds, in a nutshell, has been a way to tap into high attribute people going into small businesses that otherwise wouldn't be able to hire them, giving them incentives to behave like owners and do the right thing for their investors, supporting them, and then unlocking that entrepreneurial energy in a business that maybe, founder-led or family-owned, that had been over time turned into more of a lifestyle business. And so I'm just a big believer in attributes over time delivering these high returns. And so the goal of the support is to minimize the gap between experience and attributes in that first 2 years, right? And so a lot of scar tissue, both from my own as a inexperienced leader in a small company, and then a lot of experience working with young folks, and really try to support them, both in the things that we talked about that are common challenges, and provide them with tools and scaffolding to help them avoid mistakes. And probably the most important one is high energy, high attribute person wants to get in there and start making changes. And so we give a lot of counsel around get in there and just learn the business. Buy a good business that can support no changes. We're not buying turnarounds here. They're already on a good trajectory, and get in and learn the business and sit in every seat and talk to your people and talk to your customers, figure out what you're doing right, figure out what you could be doing better. And then after you've gathered all of that information, start prioritizing and building a plan. So it is a go slow to go fast mentality. And then we support them and provide that guidance and framework, and then the scaffolding and tools to execute on that.
Yeah, so let's talk about the businesses a little bit that you acquire. One of the ways that you can maybe get 35% returns on your investment is you buy them little ones that are at 5 times EBITDA. So there's 20% return. They're asset light and you don't pay taxes, right? So, okay, there's 20% right there. And then you leverage it with a bank loan on half of the money. Oh, there we're getting to 30% almost. But then, when you're looking at an acquisition, obviously you're getting them at a reasonable price, but what are the growth prospects? Are you looking for businesses that actually can grow organically, or that you can make further acquisitions? I noticed one of your OIRs has already made a second acquisition, right? So are some of these going to be roll-ups where you buy more and more businesses with the same operator, or what are the growth prospects of the businesses? What are you looking for?
Yeah, I think that there are two ways to look at it, but generally we're looking at businesses in industries that are growing faster than GDP. So wind at their back and opportunities for organic growth, right? And so I think primarily we're looking for opportunities that have strong organic growth potential to generate returns. That said, there's a whole another sort of universe of companies that maybe don't have strong organic growth tailwinds, but operate in very fragmented industries where there's an opportunity to grow inorganic, right, via acquisition. Our underwriting criteria on those businesses is probably even tighter around things like revenue quality. You would want to see much higher percentage of recurring revenue, for instance, if a business doesn't have industry organic growth tailwind. But then the thesis would be the growth would come from future acquisitions, right? I don't like the word roll up, but a build up via acquisition. But in that case, I think, Mark, we're still very much focused on capital efficiency, equity capital efficiency. And so we would first want that operator to buy a single company and run it for a year or two or more, both to learn the business, understand the industry in which it operates, so that it knows what a good acquisition might look like, but also to de-lever that initial balance sheet so that any future acquisitions could be done with little or no additional equity capital invested. They could re-lever the combined business, you know, the platform, if you will, and the target to finance the follow-on acquisition. So we would be, any build-up strategy would be very focused on equity capital efficiency. So in the case, you know, Timmy acquired C-Suite, we contributed very little additional equity in that acquisition and were able to re-lever the combined business to do that, which is very different than like a private equity roll-up strategy, right?
And maybe you could comment about what kind of situations the seller has that allows you to buy them at a reasonable valuation.
Yeah, I think that generally in the lower end of the lower middle market, valuations have stayed fairly constant. They've probably crept up over time as the universe of sellers and intermediaries and buyers is, you know, sort of more sophisticated. But historically, it's always been in that sort of 5 to 6.5 times range. Largely because these acquisitions have never been reliant on large amounts of debt capital to finance them. And so they're not driven by the availability of leverage. And situationally, what we're looking for are founder-led businesses or family-owned businesses, maybe it's second generation, but founder-led businesses where the owner-operator wants to retire and maybe doesn't have sons or daughters in the business and so needs a succession. And as you know, in a small company, the founder-operator is incredibly important. And so private equity has a hard time backing or acquiring those businesses because there's no management team to back. The primary decision maker wants to leave. And so search funds is like a really uniquely shaped key to solve that problem, unlock a succession for a founder-led business. And I think that's why they've been able to be successful over the last, 20, 30 years. It's really a succession alternative for a retiring founder.
Okay, so maybe one last question from me, and that is that your base business is warranty, and I wonder if you might comment on the merits of that business, and in particular, I noticed in your presentation, a few years back, before you formally started the Search Xcelerator business, you acquired a little warranty business, and then you sold it a couple of 3 years ago, and it did very, very nicely. Would you be interested in buying more warranty businesses if the opportunity comes?
Yeah, so I'll handle that in a couple of parts. One, we like the attributes of these warranty businesses. They have wonderful unit economics, diversified contractual prepaid revenue at high margin, and actually negative working capital, investable flow. The industry dynamics are not the same as our KSX businesses in that their end markets are maybe growing more like at GDP. And there is an element of cyclicality. They're tied to the consumer cycle, credit cycle. And so we would have to get comfortable with like really compelling unit economics or a very specific niche. But generally they're exposed to a little more cyclicality than our KSX businesses. They're attractive for lots of buyers, and so our ability to buy them at multiples that we would be willing to pay has been tough. But we would be opportunistic. I think that a new acquisition probably would have to be, for us, just with our strategic focus on new acquisitions under KSX, I think any new acquisitions probably would be a situation where either one of our existing companies wants to do a bolt-on acquisition, or we have an OIR that wants to buy a warranty company. I don't think that we would go buy and back in the management team.
Okay. Well, that's all for me. Thank you.
And I don't think there's any more questions from the audience, and I don't have any more questions. I think you all did a great job going through and sharing about Kingsway Financial Services. So I think that's going to wrap up. Do you guys have any other closing remarks you want to share before we end?
Well, Sean, thank you. Really appreciate the opportunity to come on here and do a breakdown of Kingsway. And Mark, really appreciate both your wonderful questions and your support.
Awesome.
Yep. Thank you, everybody. Appreciate the time.
Yeah, JT, Kent, Mark, James, thanks again for the time, and everybody who tuned in. Until next time with our next business breakdown, that's all for today. Thank you very much.